Hello students. In this video clip, I will cover the short-term cash planning and creating the monthly basis, the financial statement. Starting from the sales schedules, purchase schedules, and wages and commission schedules and the business activities. Because those business activities is based on the accrual basis, which is different from actual cash transaction. But in the entrepreneur venture business, we must track of all the business, all the cash flow, inflow and outflow to survive. Again, how the venture quantifies its vision of the near future is the point of this exercise, which is a short-term financial planning. We first measure the business activities by the schedules of the sales, purchase, and wages and commission. And then we create the cash schedules with the cash budget, and then we'll convert that information into the budgeted financial statement in the balance sheet, in the income statement and cash flow statement. And then we'll also measure the cash burn and cash build and net cash burn or build at the end of the day, how much cash we need in monthly basis. And then we'll obtain the additional financing through loan in this exercise. So hope you read the description of the new venture, the PDC company. And then PDC company initial balance sheet as of the March 31st, they have already started the business. And then for the month ended the March 31st, the income statement. So as you can see, we have this sales schedules and the purchase schedules and the wages and commission schedules, and then we'll create a cash budget. And then on the part 2, projected monthly financial statement and the income statements and the balance sheets and the cash flow statements with the cash information. Again, the reason why we need to build the schedule is that the actual business activities in accrual basis, credit sales or credit purchase or payment, and the actual collection and disbursement of the spending is different, right? So we need to distinguish these two transactions. Okay, first of all, the sales forecast on March, we started from March, and then we made this projected monthly basis, the sales forecast based on your business the projections. And then the sales forecast is comprised of this 40% credit sales and cash sales. So how do we make it? It's very simple again, exactly as indicated, 40%, right? And then it's also 60%. Again, it's based on your assumption, and that assumption should be explained by your actual business transaction. And cash collection, cash sales this month. Now the sales amount is not the total cash collection, because your credit sales based on these assumptions, this the cash collections incurred the next month, right? If that transaction was based on the credit sales. So the cash sales of this month is just the same. But the 100% last month's credit sales of the assumption should be now credit sales, where is this number? Right, this number, right? Then the sum of these two is 105,800, which is different from the sales. Why? Because the credit sales now is collected next month, right? So we have a different schedule. Now let's just drag these equations to the end so that we can get all these schedules, sales forecast, credit sales 40% and cash sales 60%, and the cash collection, cash sales this month, and then 100% last month's credit sales. Then we have the total collections. These collections will be used in the, right here, the cash budget. cash budgeting. And then this amount of sales forecast, right, will be converted into the budgeted income statement here, right? Okay, now next, the purchase schedule. Purchase schedule. Inventory policy is to begin a month with the sufficient inventory to cover 80% cost of goods sold for the next month. Next month plus the 46,000 cushion. That is every company has inventory policy to avoid inventory shortage, right? And then that inventory usually the cost of goods sold of the next month. Why? Because cost of goods sold is the actual inventory sold, right? So they need a certain percentage of the cost of goods sold the next month to be sold, right? Then how do we get this ending inventory? Then first, ending inventory plus cost of goods sold, and then we have a total the inventory needed less beginning inventory, and then we get that the purchased inventory extracted. Again, the purpose of this schedule is to budget, is to plan the purchase inventory, right? How many inventory we need, how much inventory we have to purchase additionally. Okay, then how do we calculate it? Beginning inventory plus purchase inventory minus cost of goods sold is the ending inventory. If we have the ending inventory policy, which is fixed, like $46,000 cushion plus 80% of the cost of goods sold for the next month, and then we have the cost of goods sold, certain percentage of the cost, the current sales, and then we get the total inventory needed. That is the base, right? And then minus the beginning inventory, which is the ending inventory of the prior month, then we can finally extract a purchase. How? The purchase inventory is equal to ending inventory plus cost of goods sold minus the beginning inventory. We can just change this equation, remaining the purchase, the inventory left side, and then take all this, the inventory to the opposite side. Okay, so let's go. This ending inventory now can be calculated. First, we have to know what is the cost of goods sold of the next month, as indicated here, right? Next month, right? Here we go. This is the sales. And then how to get the cost of goods sold? Right, the percentage of the sales is 70%. All the business has very like a stable, almost a fixed percentage of the cost of goods sold out of the sales, because that explains their business structure. What is the actual raw materials to produce the inventory? What is the labor cost to produce that inventory? It's not much change. So this times is 70%, right? That's 70%. Now we got the cost of goods sold of the next month. And then what we need is 80% cost of goods sold of the next month. That is the company's ending inventory policy, right? Ending inventory policy. At least they need to hold 80% of the inventory to be sold next month. And then some cushion, right? Some cushion in case the company sell more inventory in order to avoid the shortage of the inventory, and then 46,000. So we have now the ending inventory projected 149,040 in April. Plus cost of goods sold is now the sales, right? Sales times 70%. 70% of sales, right? And then the sum of this, the inventory needed from ending inventory and cost of goods sold, because ending inventory they have to have on hand, and then cost of goods sold to be sold. Then we sum these two up. And then let's beginning inventory. Beginning inventory, what is the beginning inventory there? Ending inventory of the last month is the beginning inventory of the current month. And then we connect. And then finally, we got the purchased inventory. How much inventory we have to purchase from this planning, right? And then total inventory needed minus beginning inventory, and then we got, oh, sorry, must be minus, and then we got 119,140. Now let's drag to the right. Then we simply got all the monthly basis, how much the purchase inventory we need to cover the planned the inventory to be sold for the next month, right? We need to the maintain this, the purchased inventory as well. Now schedule 4, but the purchase disbursement, actual cash out, is different from purchase because we pay later, right? As we allow our customers to pay us later on credit transaction. So here we have normally the 50% of the last month's purchase is actual cash payment, and the 50% of this month's purchase is the current month's the payment. So 50% of the last month's purchase, now we have to put the pay, right? And then 50% of this month's purchase, right? This month's purchase. 50% of this month's purchase. Then actual the disbursement for the purchased inventory is this sum. So as you can see that the purchase 119,000 and 98,000, the purchase inventory in value, in cost, but the disbursement is lower, right? You have to build this. And then let's drag it to the right. And then we have the monthly basis, the disbursement for the inventory purchase, and then purchase. This inventory information will be used on the balance sheet, budgeted balance sheet. But the cash budget, on the cash budget here, we are going to use this actual disbursement of the inventory purchase. Okay, now finally on the schedules, on the income's business activities, different from actual disbursement of operating expenses, which is wages and commissions. There will be some different amount of some additional amount of operating expenses like bills or some other payments. But let's just make it simple. The company has only wages and commissions on the operating expenses that has different payment the schedule. So we assume that the wages are paid twice a month with 5,750 per month fixed, and then 15% of the sales. Okay, again, this is based on your business plan. In this case, we have wage fixed, so just the fixed amount. We are planning in short-term, monthly basis, cash out and cash in, right? And the budgeted the financial statement. So the wages is not much changing in the near months, right? And then 15% of the current the sales, we pay our sales guy. How to get it? From here, the sales forecast times, right, the 15%. So we got it. So let's just drag. Oh, first we need to sum these two up. And then 23,000 is wages and commissions. And then you're gonna use that information where? Right, on the income statement. There you go, wages and commissions. But actual disbursement of wages and commissions is different, right? Because we have a the plan to pay those wages and commissions along with this schedule. 50% of the last month's expense, exactly the same way we did here on the purchase schedule, times 50%. Now we extracted this amount. And then the 50% of this month's expense times 50%. And then total disbursement is sum these two up. So again, as you can see, after the disbursement of wages and commissions are different from the wages and commission expenses on the income statement. Then that income statement information, that wages and commissions expenses will be used on budgeted income statement creation. But the total disbursement actual cash will be converted into this cash budget, right? How much cash we need, how much the additional financing we need to build or pay out. And then let's just drag to the right. So finally, we finished this commission schedules. Now we have those are the basics of the basic information of all the schedules, cash information. And then let's convert that information into the cash budget and budgeted income statement, the balance sheet and cash flow statement into the in the next video clip. You guys, bye bye.